Good morning and hello to this first of Wealth App's feedback on our quarterly newsletter. We thought it appropriate that in order to back up what we state in the newsletter, just to have a bit of a discussion with clients and give them feedback and share some of the source material that we use to come to certain conclusions and reach our views. Now, the people that have known us long enough know that we generally have positive attitudes towards South Africa, and we try and justify that by not just having an emotional positive view on the country, but also try and gather facts of what's actually happening. And quite often that's not portrayed through to the general public, because, as we mentioned in the newsletter as well, that we think bad news sells better than good news, and the press generally does have a bias towards bad news rather than good news. So when kicking off, I've got some documents here. You'll find me wandering around a bit. I've got some notes here to read from, and some slides on the side here. So my eyes might wander a bit away from the screen. So just bear with me during that time. I did not have this document with me when we did the newsletter, so I printed out. I just want to read some comments made by JP Landman, who's a legendary, personality and more political analyst and economist based in South Africa. So the theme is structural reform, slow but steady. So it's just a preview in terms of what's been happening in the last couple of months and year or so, or slightly longer, as well as the positive and some negatives that's been going on. And I think we must be realistic, not to state that everything is rosy in South Africa. We do have problems. We have huge problems and challenges. But the main thing is, are we dealing with those challenges, and what is being done to rectify them and to turn it into a positive situation? All right. So I think we all know that from an economic point of view, South Africa has taken a lot of strain. The whole world has. So if we look at 2020, the main economy that showed decent growth was the United States, and that was mainly driven by the big tech companies. If you take those tech companies out of the S&P 500, you'll see that the growth in America even was very mediocre and just marginally above inflation. So it was a big tech drive during 2020. South Africa only has one tech company, being Tencent, and that was also a big contributor on the performance within the JSE historically over the last couple of years, 6 years and more. So if we go look at the last 6 years, now JP Landman refers to a term that he uses calling a demographic recession. So what that basically means is that if the economy is growing less than what the population growth is, it means that everybody's getting poorer. And if we look at a population growth since 2015, it basically means that the income per capita is 11% lower as it was in 2014, a 6-year lag. So technically people in 2020 are 11% poorer than what they were 6 years ago. And the main reason is population growing at 1.6% per year, and our economy is not growing, or hasn't been growing at that rate for the last 5 years. All right, so if we look at setbacks in progress, also a document by comments made by JP. So I think one of the big setbacks was with a High Court decision to interdict the release of spectrum. An application by Telkom and ETV lodged a complaint about the rollout of spectrum. Now, for those that don't know, spectrum is the radio band that they will put in place to allow consumers to use 5G. That is incredibly important because we need to improve the way we communicate with masses and on a broad base to get it fast, efficient and cost effective. That's one way that we get communication across the board, not just through South Africa, through Africa, through underprivileged communities. It can help with education, etc. So it's hugely important to get the digital migration upgraded in order to facilitate that expansion of the communication globally. It's gone to appeal, so I think government and corporates are very pro the whole spectrum rollout. So we trust and we believe that will that will improve and that the decision will get overturned. So industry is not sitting still. Everyone is, there's a lot of activity going on. So MTN has invested 300 million rand in new fiber service to cater for underserviced neighborhoods, once again rolling out into the communities that don't have fiber, etc. MTN intends to start rollout in May this year and have 600,000 subscribers by the end of the year. So Remgro subsidiary Vumatel has gone through a huge expansion. We can see that Google and Facebook consortium are building new undersea cables to South Africa. These cables are 20 times more the capacity than the ones that was installed in 2012. So from a tech perspective, and I know us old-timers aren't all that pro and don't always understand all the tech stuff, etc., but it's a huge positive move for us to get into that space where we're on world-class communication and world-class digital operating through the rollout of a spectrum and eventually 5G. So apart from that, there's two other areas I think that we've seen a lot of activity, a lot of positive, a bit of negative sometimes as well. On the energy side, we all know the issue we have with Eskom and power outage, etc. So the Energy Minister, Gwede Mantashe, recently announced 7 preferred bidders for 2,000 megawatts of emergency power. He simultaneously opened the bid for bid window 5 for additional 2,600 megawatts to be submitted by 4th of August. Now, we're short about 5,000 megawatts in the system to prevent all the outages that we have. So if we can get additional 5,000 megawatt capacity and supply to the grid, our power outages and load shedding will very much be something of the past. So if we go look further on that, further bids for 7,613 megawatt are also to be released in the next 12 months. We can therefore look at about 12,200 megawatts being procured between 2021 and 2022. Now, obviously, these things don't happen overnight. The process of that will start in 2021. Construction to the connection will take right through to 2030. So this multi-year program is a huge boost for the economy. One expects a lot of involvement from local manufacturers and engineers, etc., to get involved in that. So the knock-on effect is very, very positive. Right. Also a big move is the changes in legislation, whereby you can now produce up to 10 megawatts without a license. This was up to recently was only 1 megawatt. So if we look at the 10 megawatt production that can be allowed, I mean, that allows a lot of small and medium businesses to basically become self-generating. So the CSIR has done a study and said that they expect that between 2,000 and 5,000 megawatt can be installed this way. Now, if that happens, load shedding will be something of the past much sooner than expected, and let's all hold thumbs that is the case. In the energy field too, private companies are marching on. So the company Earth and Wire has been launched to buy power from a portfolio of renewable energy plants and sell it directly to private customers. I mean, they've signed agreements with landowners to the tune of 365,000 hectares of land, where renewable energy plants can go up and development can take place. And simultaneously, the company are signing up power purchase agreements with buyers and will start supplying the first client in early 2022. Eskom has agreed and they've reached an agreement whereby they can use the Eskom grid to distribute this power. So that's hugely positive. That will not be the first power agreements. We've seen many substantial companies that are buying power privately. A few come to mind. You've got BMW in Rosslyn that are buying from a private supplier. Amazon is procuring power from an independent power producer for its new head office in Cape Town. Sasol has also invited bids to buy 900 megawatt from private producers, and we also know that the mines are quite active in self-producing and becoming less dependent on Eskom. Yeah, so unfortunately, these positive moves in the energy side, I think, were slightly overshadowed by the whole transaction where they acquired 1,200 megawatts from Turkey, from the ships that are supposed to dock and provide us electricity for the next 20 years. It's causing a lot of controversy, I think, in the economy. It's causing concerns about a lot of people, and we've now also had the issue of concerns raised and allegations made that Gwede Mantashe, our minister who's in charge of this, is involved in a potential corruption allegation. So let's hope that's not the case, and let's hope this gets sorted out soon. Right, and then on our harbours, Transnet has announced the call for bids from the private sector to build and operate a new container harbour in the Durban port. That's 100 billion rand investment over 10 years. And that's basically restoring the efficiency of Durban Harbour. That's just become non-serviceable basically in terms of the lack of spending on the infrastructure side, something that we will deal with a bit later on as well. So this announcement is important, especially once it's happened, also to transfer that same progress onto the Cape Town Harbour, which will be favourable for South Africa. That's a major announcement. And then also on a smaller scale, about 100 million rand has been spent this year to upgrade 10 small fishing harbours in Cape Town, Cape South and West Coast. And that's things like clearing out old wrecks of ships lying and filling up the harbours, etc., and modernising them and just improving the infrastructure. Small but important to those communities. Alrighty. So the structural reforms that JP refers to will increase investment into the country, obviously, and I think much more importantly will improve, I think, confidence by South Africans and the rest of the world, basically, in South Africa as a country. So then we get to the next issue that we discussed, is all the political fights and the political things happening at the moment. So I think there's a huge confidence booster with ongoing progress that's happening in politics at the moment. We often get sidetracked and I think demoralized by seeing what has happened in the past. Very positive at the moment now, the steps that the MEC has taken, saying that Ace Magashule and people that have been implicated must step aside, and that's going to be enforced, which is good news. That's a huge victory for President Ramaphosa and his supporters. We know there's a split in the ANC. There are two schools, the one being the Radical Economic Transformation Party, basically not party but movement, headed up by Ace Magashule, and the NEC stopped that quite aggressively. So the whole RET fraction has been put the brakes on, so that's also a good thing. And our old friend Carl Nias, who was a big supporter of the RET and a lot of radical viewpoints, has been forced to cancel all those meetings relating to the RET. So very good news on that side. SABC has retrenched 20% of staff. Now, a lot of people might say that's not good news, that's bad news. If we look at a SOE, a state-owned enterprise, that's good news. We know that the majority of our budget goes towards payment of government employees, and that's one positive step in terms of reducing that amount of people working for government and relying on those salaries. So yes, not good for the 20% people that will be retrenched. Good in terms of government spending, and that combined with the view that increases will be, well, for the last 2 years, increases were minimal, if any. Ministers have not received any income. Similar reports talking about reducing the cabinet. So a lot of positive things in terms of government spending, and that they are showing some discipline in terms of expenditure and budget control. We've also seen over the last couple of months that the government have a weekly budget on money that they can actually borrow internationally to keep the country running. And for quite some time now, they've actually not borrowed the amount that's in the budget, and they've actually taken up much less, which also indicates much more financial discipline than we saw 4, 5, 6 years ago. And let's hope that continues. So just in summary, what JP said there, The commitment of the Ramaphosa government to reignite growth through structural reform is coming more and more into focus. It coincides with ongoing private sector investment in energy, in spectrum, and soon infrastructure. The setback in spectrum will not be permitted, and in the meantime, the private sector is investing. The progress is despite the political infighting in the ANC. Because of structural reform being undertaken now, bounce back 2020 may very well be followed by more years in which economic growth will trump population growth, reversing the 6-year decline we had. Okay, so that is all from JP. I think a lot of positive views coming out there. I would now like to start talking around a few slides that we put together, and this is more based on the economy, what we expect in South Africa, why we think there's a lot of opportunities in South Africa, and not just from a South African investor perspective, but also from a global perspective. I think if we can get to the point where there's more confidence in the power supply, and I think government still needs to do a lot of work to make doing business in South Africa, especially for foreigners, to make that easier. And obviously the trade unions and so on have to also just come in line a bit. Once that's happened, then I think things can be very, very positive. Right, so if we look at the first slide, it's a performance by country. This just basically shows from January 2021, this year, what has happened in terms of world trade, which countries have done extremely well, which have done less well, etc. So if we look at the performance relative to the MECI emerging markets world, we can see on the left graph, we can see we've got Brazil, we've got India, China, and Russia, where Brazil has been the weakest performer, etc. And then if we look at the countries on the right hand side, you've got Mexico, Taiwan, South Africa, and Korea. And there you can see South Africa's been the best performer, being the red line on the right hand side. So why is this the case? Why has South Africa actually done so well? In fact, since from about October, November last year. So here we can look at the industrial commodity price index. This is a price index, a global price index, and we can see from late 2020 the commodity prices started increasing, and it's now higher than it has been for the last 10 years. So if that continues, obviously South Africa being a commodity-driven country, that can bode very well for the economy going forward. So there we can see South African precious metal exports, which is a 12-month average, and there we can see again clearly from late 2020 up to now that huge spike in how precious metals has been exported and the increase in demand of that. Okay, if we look at the curve and we see the increase in exports, there's no reason to believe that should not continue. If the confidence is there of economies and of the world that vaccine will be successful rollout, and that the virus will be beaten or reduced drastically, there's no reason why this will not continue, especially if the infrastructure in Europe, America, China, and the rest of the world for that matter, and South Africa, will continue, and the demand will be there, obviously being a huge benefactor for South Africa. Right, so all about GDP. We spoke about the GDP and where the GDP growth has not been higher than the population growth over the last 6 years. So if you look at 2021 and 2022, we can see we're looking at 4.3 and 3.5, which is well ahead of the 1.6%, which is good news. The big question is just what happens beyond 2022. And once again, if the infrastructure roll out and build in South Africa can continue, if the resources and commodity prices can remain where they are, one should expect a fairly decent return. We need a return of north of 3.5%, so more than 3.5% per year, going forward to get rid of our debt problem, and just to improve employment, which is a huge concern in South Africa. If the commodity prices stay, the infrastructure development takes place, then there's no reason to see why we can't go beyond that 3.5%. So the one big caveat is the South African government gross loan debt as a percentage of GDP. And we could see in 2018, 2019 where we were, there were projections made, and then COVID hit us in 2020. and that changed the ball game completely. Not just in South Africa, but globally. All countries and governments went through huge debt expansion programs in order to provide liquidity into the economy to pay for social grants, etc. So all the projections have just moved upwards across the globe. It's not just a South African thing. With the strong prices of the commodities that we've experienced, plus a decent export on the agricultural side that we experienced late towards last year, did improve those figures when we look at the figures that were projected like middle of 2020. So the year ended, we did end up with more in the coffers than what was expected. So the figures are slightly more improved and the outcome is slightly more positive than it was. But we ideally do not want to see to go beyond that 100% mark, which will make it very difficult to come out of the doldrums. If we look at the rest of the world, we can just see that South Africa is not on its own. So if we look at the debt to GDP ratio over the last year, we can see that Canada's increased by almost 80%. We look at Japan sitting at 55%. Go right down the spectrum. South Africa is sitting at where's South Africa there? South Africa's went up by just short of 20% for the year. Now, we were talking about the debt to GDP of South Africa sitting about 85%. At the moment, America is expected to most probably reach very close to 130% by the end of the year. Japan is sitting at a debt to GDP of 275%. They've had a huge debt problem for more than a decade, going towards 2 decades. And they also had a problem with not just debt, but with deflation, where products and so technically got cheaper for more than a decade, resulting in negative interest rates that can lead to a collapse in the banking system. We're not expecting that. We don't think we're going to be deflationary. We will certainly expect inflation to increase in time. Mainly because interest rates are just so low at the moment and there's a lot of surplus cash in the system that will spike up demand and obviously push up the prices. That will lead to inflation going forward. All right, so this change in debt to GDP is just to show that South Africa is not alone in the debt. Debt is part of the world system and it's probably going to remain part of the world system for much longer than what we anticipated. And this mainly started with the financial crisis in 2007, 2008, where countries actually did incur a lot of debt through financial stimulus to get economies going. Alrighty, so if we look at growth in fixed investment spendings per SOEs, this relates a bit to what I said earlier on. We've had a problem in terms of how the capital was applied within our budget. So when the budgets come out in terms of money that's been collected through taxes and how that money will be applied and put into the system, obviously there's budgets in terms of what they should spend in infrastructure. And for the last 10 years, it just wasn't applied. So at the moment we're sitting with bad infrastructure, failing infrastructure. That also leads to, if you don't spend the money on infrastructure, that also means it leads to across the whole spectrum of the economy, loss in jobs, production, because you don't have all the subcontractors that are tying into the system. So for the last 10 years, that hasn't occurred. The problem that we have now in terms of how to get out of that side is the one of the amount of debt that we have and our budget at the moment, where the majority of the budget is going towards paying for salaries for government employees, and a huge chunk is also paying interest on our current loans that we do have. Right, so if we look at this slide, this shows the Global Economic Confidence Index. So if we look back at 2007, 2008, we can see how the confidence index actually dropped drastically during that time. That was during the global financial crisis, and it moves up and down, and now once again through 2020, how that is dropped. What is also encouraging is if you look at the 2021 is how that has recovered, and that we are now again, from a global economic confidence perspective, almost on par where we have been since 2007. So confidence is almost recovered, which is hugely positive for the whole world, including South Africa. Right, so the global trade uncertainty index, pretty much the same as the global economic index. This one is just inverse, so a spike upwards mean bad, negative, and coming down again is it comes back to the mean at 0. So we can see also again in 2020 how the global trade uncertainty, and that was basically because of the lockdown of economies. Economies locked down, socializing stopped, no air travel was allowed, etc. So the global trade uncertainty index spiked that like we've never seen it before. And fortunately, that's also now recovered again to almost normal. The world trade volumes speak with in unison with those two previous graphs. And you can just show there the global industrial production being the red line, how that has followed the same trend as the world trade. And once again, if you look at production, is actually higher now than what it was in 2017, and trade is just about on par again where we were prior to COVID, and also back on par again with 2017 and 2018. So hugely. So if we go and look at and saying, right, so why, if all this is happening, why are we more positive now as well, and saying how can this continue? So if we look at the consumer savings, on the left-hand side is a graph of the United States, and on the right-hand side of the Eurozone. So the red line is disposable income. That's basically income that people earned during a certain period. And we can see the disposable income on the American side is hugely positive, mainly through the stimulus by the American government that physically sent checks to people, and that money was saved because they couldn't spend it because everyone was in lockdown. So if you look at the little dots, that's the savings buffer and excess capital that people now have that's sitting ready in their bank accounts, ready to spend. And exactly the same on the Euro side. We see that the disposable income didn't spike the same as America because obviously they didn't have the same amount of stimuli as the US did. But important, there's a huge amount of capital sitting there in savings that can now roll into the economies. So if we look at that expansion, we saw the global trade and the production earlier on, how that spiked. That has also led to a lot of the global markets becoming quite pricey. So this graph basically shows the different sectors in the economy. We've got growth and value, which I'm not going to go into too much now in terms of what the difference is. The S&P 500 being the American market, MECI emerging markets, where South Africa falls in, MECI Europe, and then emerging market value, which I'm not going to hover on too much now. So if we look at the 12M forward PE, so that's where it's priced now. So a PE is referred to as a price earnings ratio. That's a ratio between the price that you're paying for it versus the expected return in forms of a dividend. So if a price of a share is 100 Rand and the dividend is 10 Rand, 100 divided by 10 is 10. So that the PE then is 10. So if you look at a 10-year median forward price earnings ratio, the price for the MECI world is around about 18.2 on fair valuation. At the moment, it's sitting on 30, which means it is 66% overpriced. So if one looks at the world growth sector, and your typical tech stocks fall into that growth sector, so your Amazons, Googles, etc., they all fall in the growth sector. So that is considered to be quite an expensive sector. The rest of the world, being your normal stocks, your banks, your retailers, your consumable staples, etc., that's sitting at an 18% premium that you pay now. S&P 500 is 37% overvalued based on PE ratios. MECI emerging markets in total, in general, the index is 27% overvalued. MECI Europe 20%, and then the emerging market value side is 15%. So then if we look at the line that's the little red block at the bottom, so we look at right at the bottom, we can see that the forward 10-year median PE for South Africa is 13.7. Currently, it's trading at 10.2, which means we actually had a discount of 26%. South Africa is quite often used as the proxy of the rest of the emerging markets. And the fact that we are that cheap now, I think little has to happen in terms of attracting funds, and that little that's got to happen is that confidence in South Africa and South African politics, for that matter, needs to improve. And if that happens, we can see a substantial return to investments in South Africa. So if we go look at the allocation on stocks, obviously if we put together portfolios, we've got to invest in that's our shopping basket. We've got to go and allocate between world growth, world value, S&P 500, emerging markets, Europe, etc. So how do we do that? We're very pro offshore. We've mentioned in the past, even though this discussion is mainly more about why we are positive about South Africa, we are very pro offshore, and we think everybody should have a decent exposure to offshore investments, mainly because the universe is just so much larger that you can invest in. South Africa only forms about less than 1% of the global market. So one must have that offshore exposure, but at what price? You only place an investment in any investment if the price is right. If you can buy something at a decent price, makes sense. We're not going to go into a market that is 60% overvalued, or stock for that matter. So if we do look at the offshore side, and I've just taken an example of one of the funds that we use, and we go and look at the fund per se, and we go look at the drill down of it, we can see that fund by country has 71% exposure to the United States, 7.7% to France, 7.2% to the UK, and you can see the rest down there. But if we go look by revenue, where those companies actually generate the income from, then we see the North American exposure is less than 50%, Europe 25%, where we saw the stocks, where we saw the more value in those developed markets being in Europe, Asia Pacific 19%, Eurasia and Latin America on lesser amounts. So it's very important to, if you get a fund that's priced in any currency for that matter, if it's US dollar currency priced at, to go and just see how the drill down is and what that exposure is on the total portfolio. Okay, that's just a bit of a side tracker there. Right, so if we look at foreign ownership of South African government bonds, so right, everyone knows what a South African government bond is. There's a lot of negative things being said at the moment in terms of potential of defaults, etc. We think there is a risk, there might be a default, but we think it's highly unlikely, especially if we can curtail and keep our debt to GDP under control. And if we can attract foreign investors, that problem just becomes, or that likelihood of a default just becomes much less. So if we go look right up to 2020, we were sitting on 38% ownership by foreigners on our bond market. When COVID hit, obviously, then the whole world goes into safety mode. Everyone flees to the US dollar and gold in many cases. And in March last year, in 2020, we also had a downgrade by Moody's, which put us into, as a lot of people refer to, junk status, which I don't particularly like that term. But it did downgrade us to uninvestable bonds, which also caused a lot of foreigners to sell off their bonds. So at the moment, if you look at March 2020, it's about 25% of our bond market is owned by foreigners. Now, therein lies a huge opportunity, I think, in terms of attracting foreign investors. If we look at expectations, I'm not going to spend too much time on this graph. The little red circle there, just basically in simple terms, shows that expectations and forecasts were that the interest rates in the US will now be around about 3%. It's not the case. They're sitting at between 0 and 1%. So the broad feeling is that interest rates in the US are yet to stay for longer, low interest rates, and that will wash through to the global system. The Fed has also confirmed that they will stick around with low interest rates at least until end of 2022. They are very concerned about unemployment. So until the unemployment figures haven't improved drastically, I think we'll see low interest rates for quite some time to come. So if we look at valuations of bonds globally, you've got the bars there, the top end being brown and the green ones, the top ones being brown and the bottom sector being green. And the difference basically is the brown is your normal return, and the green one, which is the important one, is the real return. That is the return that you get from that bond above inflation. And if you look at that graph, you can see South African bonds offer the best value globally. So South Africa, at the moment, you can get a real yield, inflation above, a return above inflation of about 6.5%. If you go and compare that to United States, you can see it's negative yields. Everywhere in Europe, it's negative yields. So basically, from halfway from the bottom x-axis, you could see the world bonds are offering negative yields. So just as a matter of interest, so if an American investor invested in rands in South Africa, he would have received, if you look at a combination of bonds and equities, he would have received a return in dollars year to date of 20%. So that is attractive. And South Africa used to be the prime spot for international investors to invest in. And our markets up to about 10 years ago, up to 2010, were very sought after. And let's hope we can return back to this if we can attract the investors on our bond side. And we think we really can. If you look at what the yields are at the moment, it can be hugely positive for our economy. So once again, if we just this is just a shot of one of the fund managers. If you look at fair value for bonds, we look at the 10-year treasuries yields there. You're looking at the total return of about 3.4%. So you've got a yield of 1.7%, which is just on the inflation, just short of the inflation rate, and then a capital growth of possibly estimated about 1.5%. So on a 10-year bond, you're looking at a difference between 3.4% and 14.4% per year return if you take capital appreciation into consideration. Well, once again, this is a view of one of the fund managers. It's not a given, it's not a guarantee. Capital growth is a function of the yield. So but that is a view of a prominent fund manager. All right, so just to recap and to summarize. So if you look at the market review, broad thoughts, things to be positive about. Interest rates to remain lower for longer, anchored by low growth and low inflation. The budget speech that we had earlier was very positive for the markets, although there are still some risks that are lurking on the horizon. But overall, it was a positive budget speech. Global bond yields backtracked, driven by US Treasury sell-off. So we expect those US bonds and global bonds, for developed global bonds, we're not very keen on. It's one way that I think they're extremely expensive, and you're bound to lose money there. We expect Fed to remain accommodative for longer. I did refer to that, saying that the Fed has committed to at least the end of 2022 to keep rates where they are, very close to zero. But we also know that can change very quickly. SA real yield still quite attractive in comparison to peers. Current market volatility presents entry opportunities into fixed income products. Current 10-year yields at 9.3% versus fair value of 8.5%. So if the yield of a bond goes up, the capital value actually comes down. I mean, that's something we can deal maybe in a technical seminar at some stage. But they are selling at a quite a discount at the moment. And then cash expected to return about 4.5% versus bonds at 14.4%. So all in all, yes, we have challenges. I think South Africa and the African continent always throws curveballs and has certain challenges. But we must just be mindful that we don't get sidetracked by all the negative news out there, by prominent advisors for that matter. I'm not going to mention names now, newspapers, etc. We tend to get sidetracked and blinded and not focus and be mindful of a lot of positive things going on as well. We're optimistic. Yes, we have our challenges. Things can still go wrong. But I think if you don't have exposure to these markets, and I'm not saying full exposure, but one does run the risk of huge potential returns by not having that exposure. So our advice to clients will be to have a portion exposure to the SA market. Obviously, depending on your requirements, if you're a total offshore client living abroad, obviously that does not apply. Then there's a total different strategy in terms of what those portfolios should look like. But please send us your comments in terms of if you found any value in the video clip that we're going to send you. And then also, if you want to mention anything that you'd like us to cover going forward in our newsletters and in likewise kind of video clips, we are considering doing live webinars going forward. We just found that or thought that the video recording like we did it today will most probably add a bit more value, and we can distribute it slightly further and we can place it on the website. But your thoughts will be much appreciated, and once again, thank you for being clients, thank you for supporting us, and stay invested. All the best. Bye-bye.